think if we're ready, if Marc's ready, we're 2 minutes early. Marc, give us a thumbs up if you're ready to talk or you need a minute. But I want to just introduce Dr. Marc Faber. He writes the Gloom, Doom, and Boom report. He's an economist. I don't know. I misplaced your bio. I'm sorry about that. But I know you've been with us before. And I've read your newsletter for, I don't know, you could check your subscriber records, but it's been at least 17 years, I think. I've read your report, and I've always found it really valuable and really interesting because you've pointed things out. I would say you're a contrarian. I think that's fair. I don't know if I think that's fair to say. But you found things that were really interesting. You always had interesting perspectives that I didn't hear people talking about. And a lot of the things that you said over the years were I've acted on and were really good. I think you really actually first tuned me into Argentina, and then when Milei came in and all that. And so many things over the years. And so it's a great honor to have you here again, Marc. And so everybody just give a big hand for Marc Faber. All right, Marc, I'm going to turn it over to you and for your presentation. I'll come back on in a little bit and we'll do some Q&A.
Great. Well, thank you very much, David, for the kind introduction. And good day to all of you here in Chiang Mai, in the north of Thailand. It's in the middle of the night at 4 a.m, but it's not a problem for me. Anyway, we better go to the next chart. I will give you the command next, and then you just change the figures. Next. I mean, the presentation centers around changes that are occurring in the world that I feel that are important for investors to realize, and that these changes will imply very different strategies going forward than what we had in the last few years or even 40 years. So one of them is very clearly, for the last, say, 25 years, we had the emergence of new markets, India, China, Brazil, the former Soviet Union, and so forth. And numerous of these countries, they have very large population, and therefore the impact on the demand side for raw materials and also for consumer goods is enormous. I mean, on a per capita basis, China and India will never reach the wealth that we had in the Western world, in Europe and in the US. But because their population is so large, it will have a huge impact on the demand side. And you can see it here, the example of oil consumption of China and the US as a percent of the global oil consumption. China is obviously keeps on rising. And please turn next. And India will do the same. The column you should focus upon is the last one, the yearly gallons per capita. And you can see that the third country, China, India, the per capita consumption is extremely low. So if they just go to the level of China, which would be 3 times larger, it would have a huge impact on the oil markets. I'm bringing this up because later on in the presentation, I shall try to show that raw materials, commodities, are relatively depressed, especially against financial assets. Next. One thing that we also need to realize is that China, which had these enormous growth rates after 1990 of about sometimes 8 to 12% per annum, that is not going to be repeated. The Chinese growth rates will settle down trend-wise at maybe 3-4% per annum for the next 10, 20 years. And India will grow at a faster rate. But the miracle of China's growth in the last 20 years, that is not going to be repeated. Next. An important development is the rise of BRICS countries. More and more BRICS countries are joining, and you can see that the organization has expanded and now includes countries like Argentina and Brazil, and also Egypt and Saudi Arabia and Iran, which I think is important, because if it comes to a conflict with Iran of the Western world, it will be interesting to see to what extent other BRICS countries will be supportive of Iran. Next. Important is also to realize, in the context of the tariffs that Mr. Trump is imposing upon the world, that he's taking on essentially, the last column you can see at the bottom is population. He's taking on essentially 88% of the world's population. And countries like India that have over 1 billion people, and China that has also over 1 billion people. And what the result will be is highly questionable. My view would be, first of all, the tariffs is a massive tax increase on the American consumer. It's the American consumer that will largely pay it. It's going to be collected by the corporate sector in America. The corporate sector in America last 12 months, had profits of $366 billion. And now they will have to pay, essentially through the tariffs, over $300 billion. That they will roll over to the American consumer, but some will probably stay with the corporate sector. So it could be that these tariffs are actually very unfavorable for American corporate profits. Next. Global trade has not been expanding as a percent of the economy, of the global economy. It's been actually contracting. And I think the tariffs will accelerate this trend, which would, in my opinion, be negative for economic growth. I mean, if you think a bit of tariffs, New York City, Manhattan has a huge trade deficit with the rest of the country. Why would Manhattan impose import duties into Manhattan? Who would pay that? Essentially, it would be paid by the people who live in Manhattan and who shop in Manhattan. So I think global trade depends on a well-functioning supply chain mechanism, and tariffs are negative for global trade, and hence also negative for economic growth. Of course, Mr. Trump, he portrays that foreign countries have ripped off America, but it's not entirely correct to think that way. Why would Americans want to work in sweatshops and produce jogging shoes and so forth? America and the Western world, Europe notably, has been a beneficiary of people willing to work at low wages in countries like Vietnam, China, and India. So I could argue, well, Nike produces shoes in China or Vietnam, and it buys these shoes at $10. Then these shoes are eventually sold in department stores at $150. I mean, it's a very good business for the US and not very good business for the producing countries. But this is a separate matter. Different people look at the world from different perspectives. Next. one characteristic of the changes that will likely happen is the following. If we look at the 19th century, what the socialists called the robber baron days, we had price stability between 1800 and 1900, and we had very low government expenditures during that time. No Western country had government spending of more than, say, 10% of GDP until 1913. And in the US in the 19th century, the federal government spent 3% of American GDP. But after the creation of the Federal Reserve, the government expenditures as a percent of the economy grew everywhere because of social security programs and subsidies and so forth and so on. So we have essentially a capitalistic system in the 19th century, and in the 20th century, an expansion of government expenditures at the expense of the private sector. Next. And that then gives rise to government debt, because the government expenditures are not entirely financed through tax revenues. It's difficult to tell people, the government hands out money, but your taxes will go up. So what the governments do is they hand out money, but they borrow what they hand out to a large extent. So we have the explosion of deficits, and the public debt keeps on rising. It's now in the US 37 trillion. Next. And as a result of that, obviously the interest on the debt goes up, but it doesn't go up only because of that. It also went up, as you can see here, after interest rates began to rise. And there, I have to say, we had in the last 40 years a wave of downward movement in interest rates between 1981 and 2020. And after 2020, when bond yields reached an all-time low, we have a rising interest rate structure. And if you assume that the debt in the US will continue to grow, we have to assume that the net interest paid of the government debt will also continue to grow unless interest rates go down significantly. But as I shall explain later, it is unlikely to happen. Next. One of the problems or one of the facts that surrounds US assets is that a substantial portion of US assets are held by foreigners because the US has a negative net investment position. In other words, foreigners own many more assets in America than Americans own assets overseas. And so approximately 30% of the treasury market is owned by foreigners. And their behavior has an impact on the prices of these securities, obviously, including shares, of which they own, I think, about 20% of the equity markets are owned by foreigners. So that has been favorable for the US, but it will depend on the behavior of foreigners, how these assets are priced. Next, these problems that I discussed briefly and admittedly very superficially are not endemic to America. I mean, other countries are much worse. You can see here nominal GDP and nominal public debt grows practically everywhere. Debt is growing at a much faster pace than GDP. And in my view, this will not be sustainable in the long run. Now, having said that, what is the long run? I would have maintained this view already in the 1990s. And here we are 30 years later, and still debt is growing more rapidly than GDP. So who knows? But clearly, we're moving into dangerous territory next. I'm sorry, I can only touch on these issues very superficially because of time constraints. One thing that is also interesting to note, the Fed and the media and Wall Street will tell you that the US has tightened monetary policies. But this is not my impression. If I look at asset markets, in my view, asset markets tell you that monetary policy or say liquidity has expanded and not tightened. How could you have record stock prices, record residential real estate prices, record prices for collectibles, and so forth and so on? If liquidity was really tight, how could we have spreads between lower quality and high quality bonds that are so tight if liquidity was tight? So my view is that actually liquidity has expanded and that people don't really know how to calculate liquidity anymore. But M2 keeps on growing and is at the record high. And what the assets market are showing is that liquidity has actually continued to expand. And here you have money market fund assets. They're over $7 trillion. This is money that theoretically can flow into assets such as bonds and stocks and so on. So be prepared for additional volatility in the next 6 months to 12 months. Next, it's also interesting that while some people are enjoying record liquidity, including myself, I'm in the financial field, I never had that much liquidity in my business, but others are struggling. So we have a bifurcated economy where a small group of people is becoming immensely wealthy because the money is flowing into their pockets or into their businesses or into their assets. And the majority of people, the typical household in Europe and in the US, is struggling. And more people are living paycheck to paycheck because the cost of living is going up much more than the salaries are increasing. And we had some question marks about the statistics of the Bureau of Labor Statistics. But the worst is the composition of the Consumer Price Index that does not reflect the cost of living increases of typical families. Next. So the global investment implications are as follows. I mean, the problems aside, which I discussed of the debt, that is going to be a major issue in future, that has to be addressed either by taxation. We have to increase taxation meaningfully. The tariffs are a tax, but it's not that much. It won't make that much difference on the fiscal deficit, and it could actually worsen the deficit. It's also politically very difficult to go to people and say, you know, we have to increase your taxation. So that is not very likely to happen. The payment of debts, but if you look at the financial system, the Treasury issues bonds, government bonds, and they are held largely by financial institutions such as endowment funds, pension funds, government pension funds, private pension funds, insurance companies, and so forth. The default would be extremely messy. The other thing, you can go and say, well, we have to tighten our belt. That has been done in Argentina and Milei. and has been successful. But because it's been successful, the media doesn't talk much about it because it implies a smaller government and less regulation and less interventions. And let's be clear, whether you talk about the Democratic leadership or the Republican leadership, especially on Mr. Trump, they are extreme interventionists, especially Mr. Trump. He intervenes into everything, which is against basically the free market system, the capitalistic system. So I would argue that what is likely to happen on the both parties is that they will continue to print money and finance the government debt by essentially increasing the balance sheets of the Fed in time and keep on creating liquidity, which then leads to inflation. I mean, the fact in a democracy is people like government expenditures, but they don't like the consequences, which is inflation. So the likelihood, in my view, is that inflation will actually accelerate and that interest rates will go up in time, whereby, as I shall explain in a minute, they can go down for cyclical reason for 6 months or 1 year, then continue to go up. I think that when I look at the world, we see undervaluation in foreign countries. And I think the dollar is likely, in this scenario I described, is likely to lose value as it has in the past, with the exception of the last 10 years. But long term, I think the dollar is a doomed currency, and that precious metals will be a rewarding investment as they've been in the past. So please, next. I discussed briefly the monetary easing. It has continued. Next. You can see M2 is now at the record high. It was shrinking a little in 2022, but now is expanding again. And in my view, this will continue. This is the easiest solution for governments, has always been employed everywhere. Next. The gold price reflects the price increases in the economy. As you can see, gold was relatively stable until they exited the gold windows in August 1971. And since then, the trend is clearly up. Now, can it go down for a few years? Yes, it's possible. But for reasons I'll explain in a second, my view would be that it will go down, but from a higher level. Next. Commodity prices move in long-term cycles. We call them Kondratievs. They last 40 years to 60 years approximately. And they obviously imply interest rates movements as well. So when commodity prices tend to move up, interest rates also tend to move up. And when commodity prices tend to move down, as they did after 1980, interest rates also tend to move down. Next. The US experienced two distinctive periods. A period of no inflation in the period between 1980 and 1900. And after the creation of the Federal Reserve, we had accelerating inflation, which has continued to this very day. Important is to realize that interest rates move in long cycles. In other words, we peaked out in 1921, and that the trend for interest rates was down until 1942. And after the war, the trend of interest rates was up and inflation was up until essentially 1981. And interest rates then peaked out, as you can see here, in 1981 in September. on the 10 years over 15%. But in the 70s, you can see we had many occasions during which interest rates were cut in half. In other words, we had strong bond market rallies, and then bond yields made new highs, and then they rallied again, and then they went up again, and so forth. And I would expect the same to happen going forward, that now interest rates can go down for maybe 3-6 months, but that they, within 10 years or 20 years, they'll be at new highs. In other words, the 10 years treasury will be higher than 15% per annum. Next. The question is, again, what will happen immediately? For investors, the belief is that interest rates will go down. So the bond market, to some extent, may already be pricing some interest rates declines. But what contradicts this view is the very heavy short position in treasury bond futures. In the futures market, the speculators are extremely heavily short at a record level treasury securities. The commercials are long, offsetting the large short position of large speculators. I also went long bonds. I always have in my asset allocation a bond portfolio of around 25%, which consists of bonds and cash and deposits and so forth. But I always have bonds, and I'm now lengthening the maturity because I think that interest rates will go down due to the fact that the economy is far weaker than what the statistics suggest. Next. Remarkable is the interest rate increase in Japan. And if we talk about fiscal deficits and a hopeless debt situation, Japan would qualify. This is a complete disaster. And I think most of the tax revenues will be eaten in Japan by interest payments on the debt. So how this will end, I don't know. But I think it could have an impact on global liquidity because, as I mentioned before, the US depends on foreigners holding treasury securities and stocks and so forth. If this liquidity tightens in Japan, and possibly elsewhere, the liquidity position internationally may deteriorate and have an impact on the pricing of bonds and, of course, also of the dollar. Commodities, as I mentioned before, are relatively low vis-a-vis the S&P. Next. And real assets in general are low vis-a-vis financial assets. One example you're all familiar with, and that is an interesting example, that even if you print money, some assets can decline in value. Commercial real estate, no matter how much money they're going to print, some commercial real estate will stay depressed for a long time because it's not going to be occupied anytime soon. The only real estate markets which I sort of like at the present time are real estate markets in Asia, notably China and Hong Kong. They are very depressed, and the stocks or the companies that own these assets are selling at huge discounts vis-a-vis the asset. So I've been bearish about documented about Hong Kong real estate for a very long time. That's why they call me Dr. Doom. But now I think that Hong Kong real estate is attractive. Also, energy is relatively low as vis-a-vis the S&P. And as I said, I think the demand for energy will go up also because of all the energy use in data centers and so forth. So that is a sector I would favor next. And then I need to spend some time explaining my view about gold. First of all, I've been telling people that they should have some exposure to gold for the last 40 years, for the simple reason that the quantity of money was increasing everywhere, and that gold shares and gold after 1980 went into a bear market. And as you know, it bottomed out around $253 in 1999. But so relatively speaking to financial assets, it became cheap. What is remarkable is that the gold market has rallied, but the gold allocation is still very low. It started to increase in the last 2, 3 months, but up to now, you have a huge bull market in an asset classes that has been neglected by the investment community. Next. This is the gold mining industry relative to global stock market capitalization is near a record low. So I think that this is philosophically, my view is this. We have these huge financial markets in the world. 60% of global stocks are, say, US equities. The money over time will flow out of US equities, which have outperformed everything, and flow into depressed sectors around the world. My view may be wrong, into stocks like Hong Kong shares and Asian stocks and Brazilian stocks and Latin American stocks and so forth, and into gold and silver and platinum. And you will not need a lot of money to boost these prices significantly because the market cap is so low. Next. And in the case of gold, as you can see, the gold as a percent of foreign exchange reserves by the central banks has been diminishing since the 1980s. And now central banks are beginning to, again, accumulate gold for various reasons. I don't want to go into all the reasons right now, but for various reasons, countries like China and India and Russia and so forth, they have a preference for owning gold vis-a-vis owning US financial assets, notably treasuries. Part of the reason being the expropriation risk or the seizure of assets. Next. The gold miners have not yet participated meaningfully in the gold bull market, except in this year. I mean, the gold shares performed miserably in the last few years relative to the price of gold, but they've done well this year. The GDX ETF, which is widely used in the financial community, GDX ETF is up this year 69%. So I think people will wake up to the fact that there is some money to be made. Next. The reason I don't think we are yet in a bubble in the gold market is that until recently, this is most unusual. You have the price of the GDX going up, of gold shares going up, and the ETFs are losing assets. It's very unusual. Normally, when a sector goes up, there's a huge inflow into these ETFs and it comes to a bubble. But this hasn't happened yet in the case of gold. So I don't think that we're near a bubble. Next. Platinum and silver to a lesser extent, but especially platinum, would seem to me to be incredibly low compared to gold. And the market is much smaller, and I think it could be squeezed. I mean, if I were Russia or South Africa or a big hedge fund, I would squeeze the platinum market. it would be much easier to squeeze the platinum market than it was at that time in the 70s. The squeezing of the silver market by some institutions and wealthy people in Dubai and Saudi Arabia and the Hunt brothers. It was a Mr. Ashraf in Dubai who developed the theory to squeeze the silver market. And he went to the Huns and he persuaded the Huns to participate. So that it came to a huge silver squeeze. But it would be much easier to squeeze the platinum market. So I would invest or hold, especially at the present time, because the platinum occasionally trades at a premium to gold. But now it is at $1,300 thereabout, and gold is at over 3,000. So the platinum market is still very, very depressed vis-a-vis gold. Next. Here you can see a steady uptrend in platinum price. Next. Emerging equities are very inexpensive relative to the US. They just started to outperform the US since the beginning of the year. Next. US equities are at the record high vis-a-vis the rest of the world. And my view would be like Japan after 89, that the US equities will deflate, especially the FANG and FANG-related stocks where expectations are very high. Next. Europe, after, say, 10, 15 years of underperformance, also just started to outperform the US. And I think this outperformance will continue. Next. The intensity of a bubble can be measured by the concentration of holdings in a market. So when you have 10 stocks that make up a very large portion of the index, it's a sign that sort of a bubble has developed. At the present time, 10% of the market is 76% of the market cap. So I think that like after 2000 or after 1966, this will be deflated. Next. We have a euphoria meter. It's been at the record level. It's starting to ease down. Next. Remarkably is that margin debt has reached a new record, not as a percent of stock market capitalization, but we're now at over $1 trillion margin debt. And I think in the next downturn, we'll see a huge deleveraging and margin debt coming down, especially if interest rates went up from this level, as I believe they will eventually. Next. We also have record speculation, again, a sign of a mania, an investment mania that is colossal. I didn't even know it existed, this one-day auctions, but it's widely used and the volume is huge. Next. The gold miners relative to the S&P have been very disappointing until this year. They just started to outperform the S&P meaningfully, and I think this will can continue for next 5 to 10 years. So that is a sector I would focus upon. I think the institutions will buy Barrick and Kinross and Newmont Mining, these type of large market cap stocks. But the big gains will be in small cap stocks in the gold mining sectors that can go up 10 times very quickly because there's no liquidity. The monetary policies in the US are complex because the asset markets are so inflated, and the Fed, although I have a low opinion of them, but the Fed must be concerned of the negative wealth effect if asset prices come down. Say, if home prices drop 30% across the board in America, I think it would have a huge impact on consumption. If the stock market went down 30%, I think it would depress consumption. And so the Fed, I'm not sure I mean, for sure, Trump, he is sponsored by people who, if the stock market drops 10%, they'll call him up and say, do something. And then he reverses his policy, so the stock market keeps on going up. The view is the administration doesn't want the stock market to go down. But the housing bubble is here. And as you can see, the current housing bubble is much bigger than it was in 2007, 2008. And the downturn in Canada and the US and also in Europe can be very substantial. Next. I mean, just as an example, this is a building that was sold for 44 million. The last time it was sold in 2018 for 92 million. I mean, the downturn in commercial properties in America is staggering. And some buildings will just not be reopened. They cannot be used again. Next. The housing affordability is at the low point. This is the work of the Federal Reserve because they wanted to boost asset prices and forgot that the buyers are young people that want to have a house or a household and they can't afford it. Next. Latin American equities. This is a sector I like because in World War III, I'm not necessarily a believer in World War III, but I have friends, they are very close to the State Department. They are convinced that we're heading into World War III. And I would keep it in the back of my mind that the tensions today are very high because we have a superpower, the US. And we have powers that are coming up that want to displace the US as a superpower. And that leads to very significant tensions internationally. And I don't want to give a speech about geopolitics, but previous war cycles indicate that the conditions for global conflict have improved. In other words, the conditions do not have to lead to a global war, but they have significantly improved. So, as an investment or as an investor, I think that I want to be in assets that wouldn't be overly vulnerable in a global conflict. Everything will be vulnerable, but some less than others. Next. It's remarkable how the media, especially in Europe and the US, turned negative about China. Until about 2015, they were rather positive about China. And now whatever you read is negative and so forth, and everything is blamed on the Chinese. And the US, as you know, imposed sanctions, and they also have restraints on companies. They embargo companies, and they don't allow American institutions to buy these companies. But the Hong Kong listed, blacklisted companies have actually outperformed everything else. So it's an example how dumb the American State Department is actually. They should have they should have encouraged the blacklisted companies to do well, and the Americans could have benefited from that. Next. That's the performance of the Hang Seng Index vis-a-vis the S&P. This year, it's grossly outperformed the S&P. I think there's a great opportunity in Hong Kong property stocks. And as I said, I've been negative about Hong Kong. I wrote the book, The Rise and the Fall of Great Cities in 1997. But I think now Hong Kong has over-discounted the negatives. Next. India stocks are very high. I would avoid them. Next. And these are the conclusions, essentially. I mean, I would be cautious about financial assets, but I would also remind people that inflation is very complex. The money that is being created and printed can flow into one corner of a room or into another corner of the room. And in the last 40 years, it flowed into asset prices. My concern is that asset prices will go down in value. Exactly why and when, who knows, but they'll go down. Now, assuming asset prices across the board decline by 50%, some decline by 80%, say, NASDAQ after March 2000 went down 83%. No, as an investor, you want to avoid being down 80% or 90% as after 1929. And you may want to be down just 20%. And to achieve that, you need to be in sectors that are probably now sort of neglected. I would think that if asset prices collapse or they go down gently, like after 1973, they went down for years and years. In that situation, I think you should be in precious metals physically, but ideally outside the US. Thank you very much for your attention.
Thank you, Mark. Hi. Now, Mark, you got nothing very positive now. So I want to ask you a question. I know we have a few minutes to do a couple questions, but so in a scenario where, like, what happens with the debt? A lot of people talk. Ray Dalio writes a lot about a debt crisis, and what would a scenario look like where that would play out? And like I know you have this theory, like the one who loses the least wins, sort of type thing, right? If you only lose 20% and the market goes down a lot more, that's you win, right? You've won. But how would it play out? What would go up? What would go down in those types of scenarios? Do you have any idea of that, like practically speaking?
Well, I mean, practically speaking, I think gold will go up, but I accept someone's argument that in a debt deflation period, everything goes down. Mm-hmm. But as I said, my view would be that it would go down. I mean, gold would go down less than other assets. Mm-hmm. And as an individual investor or as an institution, I think you should have at least 20% of your money in gold and gold-related investments.
Yeah.
20%. At the present time, very few institutions have any exposure to mining stocks at all. Yes. Depending on the countries. In Australia, people will have more exposure. In Canada, they'll have more exposure. But in the US, the exposure is concentrated in the tech sector and the media and, meme stocks and cryptos and so forth. Yeah. But I think in a debt, the debt crisis is inevitable. The question is when. And here I have to say that it can take a long time. I mean, when I started to work in 1970, that expanded into 1980, and then after 1980, the household deficits in the US under Reagan exploded. And at the time, there were three strategists at Merrill Lynch: Charlie Minter and Aronson, and another one. His name slipped my mind. And they wrote reports that the US would go into a debt crisis very soon, and that interest rates would soar, and that the dollar would collapse. And it didn't happen until it still hasn't happened. Because you can keep on printing money, you know. And what I want to stress is, in the US, the interest rates, say, are higher than they were in 2020, 2022. But the 10 years at 4.5% is not very high, and money is not tight. You can have interest rates at 100% like in Turkey, and money is not tight, because the rate of inflation is 101% or 105%. So Milton Friedman has written about this extensively. The absolute level of interest rates does not tell you whether money is tight or not. Not at all.
Yeah.
And in my case, you see, I'm an investment advisor and an investor, and have a large liquidity. So 4 years ago, on the liquidity I need to maintain for my business, I had no return, zero interest, essentially. But now I got 4.5%.
Yeah.
And this is very desirable for me, because without doing anything, on $1 million, I get $45,000 a year, which is not much, but it's much better than what I got at 0% interest.
Yes.
And on $10 million, $100 million is a lot of money. So all I'm saying is, the liquidity for some people, say for Bill Gates, Jeff Bezos, and all these characters, the liquidity has improved a lot. For the lower income recipients who have variable mortgage debts and who have credit cards and other forms of consumer credit or student loans, the situation is dire, because the interest rates have gone up. They're being squeezed very badly. That's why you have so many people that live paycheck by paycheck.
Yeah.
The economy, what the Fed has, I mean, what central banks have done with the money printing is a complete distortion of the economy, with the financial sector drowning in liquidity and ordinary people drowning in debts. I mean, you have to laugh about what they wanted to achieve and what was achieved.
Yes. Yes.
The affordability issue is there. I mean, this is a fact.
Mm-hmm. Well, let's take one more from the Brian. Let's take a question. Maybe face the camera so Mark can see you.
Oh, hi, Mark. Thank you so much. That was super helpful. So one of your big themes was to buy precious metals, especially gold, but also to do it outside the U.S. So a couple questions on that. One, should we be looking to actually own that in non-U.S. based currency, given the potential devaluation of that? And then secondly, what about other mining companies for things that we need, like copper, molybdenum, lithium, things of that nature?
Yes, this is a very good question. You just buy gold, doesn't matter in which currency. The gold price has moved up against all currencies. Now, it's moved up less against the Swiss franc then against, say, the dollar, or it's moved up less in Swiss franc than, let's say, against the Indonesian rupee. You understand? But it's moved up. And I would be long gold against all currencies, regardless. The currency movements is very complex because nobody knows where the currencies will be against each other, because it depends on monetary policies. You see, Switzerland, our 10 years bond yield is, say, 0.5%. So the dollar yields on 10 years over 4%. So over 10 years, the Swiss franc would have to move up by, say, 50% against the US dollar for you to be at an advantage by holding Swiss francs. I don't think this will happen, but I can give you a portfolio of Swiss stocks that will yield 4 or 5%. And then maybe it's a good thing to own these stocks because the stock yield is that much higher than the bond yield. This is a valuation method. But anyway, I would hold gold, and I would hold all my assets diversified in different geographical locations. Because if World War III happens, you're not sure who will be based off. Say, I live in Thailand, I want to have enough money in Thailand that I don't depend on remitting money from overseas into Thailand. That one day may not be possible. So I want to have enough assets in Thailand to survive from those assets, including gold positions. And gold in Thailand is a bit different than gold outside Thailand. But it's a very liquid market. Now, I also, concerning gold, I must explain to you one thing. When an economic crisis happens, say in Thailand, the economy is doing badly. Everything is bad in Thailand, the political situation and the economy and everything. Anyway, when this happens, people are squeezed. And what do they sell? Can they sell their motorcycle and their cars? They need these consumer goods to go to work or to bring the children to school and so forth. So they're not likely to sell them. They keep on paying the interest on the debt, on the consumer debt, the installment credits. The house, they don't want to sell because they really believe in real estate. And they don't want to sell for prestige reasons. All the neighbor would see these people must sell the house and downsize. But the gold they own, they can sell and nobody sees it. So during the bull market in gold, for a long time, people were selling gold and were not buying. The gold sales of Thailand actually increased for the last 2 years. Now, recently, Thailand has become again a net buyer, but until now, they've been selling. So that's why the gold price didn't move much for a long time because of the selling pressure. And geographical location, whether you own stocks or bonds or physical gold and silver, I would hold in different locations, say in Hong Kong, Singapore, Dubai, Switzerland, and so forth, not only in the US, because one of the fears I have, and that also concerns, say, companies that are gold miners. Newmont Mining has an all-inclusive cost of gold that includes everything of about $1,500 an ounce. The price of an ounce is now over 3,000. I mean, someone in the Trump administration will suddenly say, these are excessive profits, we're going to tax it. Or we're going to nationalize a new one, who knows? The government, they can do anything. They are a tyrant. And we must fight the government on every occasion. And we must reduce the government. The government is a cancer that needs to be addressed. They have gained far too much power.
All right. Marc, on that positive note, and I think you got a lot of people who agree with you on that here. So everybody give it up for Marc. Thank you, Marc.